As of April 8, 2025, the economic tensions between the US and China have escalated once again. The ongoing trade war between these two superpowers is shaking the foundations of the global economy, affecting supply chains, stock market movements, and foreign exchange markets worldwide. The state of the US-China trade war has expanded beyond economic relations to encompass technology, energy, and military areas. In particular, the increase in import tariffs imposed by China on the US, along with the US responding by raising tariffs on Chinese goods and intensifying competition in the tech sector, has led to a significant economic divide. The US government is planning stricter measures against China's tech giants. For example, the trade bans imposed on China's largest tech company, Huawei, are seen as a move to reduce China's influence in the technology market. In response, China has raised tariffs on US goods, retaliating with its own set of economic measures. This situation has led to significant uncertainty, especially in the technology and telecommunications sectors. On April 8, US tech stocks experienced notable losses, primarily due to the weakened trade links between these firms and China. For instance, major US tech firms like Qualcomm and Intel saw declines of 3% and 4%, respectively. These losses stem from China's strategy to reduce its dependency on the US by investing more in its own tech companies. At the same time, China's focus on green energy technologies and innovative infrastructure projects is gaining momentum. The Chinese government, following its 2025 goals, aims to become the global leader in electric vehicles, EVs, and solar energy panels. Chinese companies are focusing on strengthening their domestic markets and reducing dependence on Western nations. This strategy not only aims to sustain China's economic growth, but also seeks to shift the balance of trade in favor of China. These shifts in China's strategy are reflected in global supply chains, with the reorganization of these chains in response to China's new trade policies. Particularly, China's investments in green energy projects are expected to have significant effects on global energy prices. On April 8, 2025, China's announcements regarding its new energy investments support growth expectations in the renewable energy sector. In foreign exchange markets, another important development is the strength of the Chinese yuan. On April 8, the yuan gained 0.5% against the US dollar, trading at 7.10. This appreciation is driven by China's increasing trade surplus. As China faces off with the US, it is using its currency strategy to strengthen its position in global trade. The rising value of the yuan reflects China's goal of expanding the international use of its currency while also increasing demand for yuan in emerging markets. One of China's key economic weapons against the US is its control over rare earth elements, REs, and minerals. China controls a significant portion of the global production of these materials, and by restricting the US's access to these resources, it can exert pressure on the US. The ongoing trade tariffs on the US also serve as a way for China to leverage its dominance in the RE market, which can have significant implications for the technology and automotive industries. As the trade war between the US and China continues, the impact is not limited to these two countries alone. Many developing nations are finding new opportunities due to China's new trade policies. Countries like India, Indonesia, and Vietnam are stepping in to fill the gaps left by China, strengthening their positions in global supply chains. This shift presents new opportunities for investors, as these countries may become more attractive for manufacturing and trade. On April 8, the Indonesian rupiah appreciated by 0.3% against the US dollar, trading at 15,000, and the Indian rupee also gained 0.2%, reaching 82.4. These currency fluctuations are indicative of the growing importance of developing markets as China's position in global trade shifts. The economic war between the US and China continues to have profound effects on global markets, and its implications extend far beyond just the two countries involved. Investors and companies worldwide must stay alert to how this conflict will reshape global trade and economic power structures in the coming years. The impact of this trade war is also evident in the energy sector, as China moves toward greater energy independence with its massive green energy projects. Global energy prices could see fluctuations. With China's investments in solar, wind, and electric vehicles, there is an emerging opportunity for countries and companies to tap into these sectors. As we look to the future, the economic battle between the US and China shows no signs of slowing down. with both countries focusing on technological and energy dominance. The global economy will face significant challenges and transformations. The impact on global markets could be substantial, with companies in the tech, energy, and automotive sectors feeling the most pressure. To sum up, the economic war between the US and China is fundamentally reshaping the global economic landscape. The strategies adopted by both countries will have far-reaching consequences, not just for their economies but for the entire global market. While the trade war continues to evolve, it is clear that China's policies are driving significant changes in global trade dynamics. If you want to stay updated on global economic developments, identify opportunities in emerging markets, and make informed investment decisions, make sure to follow the Economin channel. Don't forget to like, comment, and subscribe to stay up to date with the latest economic analyses and trends.